Did you know that pulling money from your 401k even one day too early could trigger a 10% penalty from the IRS on top of regular income taxes? This immediate tax bomb can cost you thousands, turning a $10,000 withdrawal into only $7,000 after a 10% penalty and a 20% tax bracket. The standard age for penalty-free withdrawals from your 401k is generally 59 and a half. Though some exceptions and the Secure Act 2.0 have introduced changes to this. This isn't just a guideline. It's a hard rule established by the IRS designed to encourage long-term savings. Ignoring this age can severely diminish your retirement nest egg before you even begin. It's crucial to understand this baseline before considering any other withdrawal strategies. But what if you need the money sooner? There are specific exceptions, often misunderstood, that can save your skin. Stick around as we break down exactly how to navigate these tricky waters without losing a huge chunk of your savings to Uncle Sam. One powerful exception to the 59 and a half rule is called the Rule of 55. This rule allows you to withdraw from your 401k without the 10% early withdrawal penalty if you leave your job in or after the calendar year you turn 55. This applies whether you're fired, laid off, or voluntarily quit. Crucially, the funds must remain in the 401k plan of the employer you just left. If you roll it into an IRA, you generally lose this specific exemption for those funds. Imagine you're 56, you decide to retire, and you have $300,000 in your 401k. Under the Rule of 55, you could take out $20,000 to cover living expenses without paying the 10% penalty. This can be a game changer for early retirees, offering flexibility many don't realize exists. But what if you rolled over your funds to an IRA years ago? That's where things get much more complicated, and the next strategy might be your only option. Another crucial strategy for early withdrawals, especially if you've rolled your 401k into an IRA or want more consistent income, is the 72T substantially equal periodic payments, or SEPP. This allows you to take penalty-free withdrawals before age 59 and a half, provided you take a series of equal payments over your life expectancy. The amount is calculated based on IRS-approved methods, and once you start, you must continue these payments for at least 5 years or until you turn 59 and a half, whichever is longer. Let's say you're 50 with an IRA of $400,000. Under 72T, you might be able to withdraw around $15,000 to $20,000 annually without penalty, depending on interest rates and life expectancy tables. The catch? Deviating from this payment schedule can retroactively penalize all previous withdrawals plus interest. It's a powerful tool, but requires strict adherence, and failing to understand its rigidity can cost you big. There's another major consideration: the required minimum distributions, which kick in later in life. Required minimum distributions, or RMDs, are another critical aspect of 401k withdrawals, but they apply at the other end of the age spectrum. Once you reach age 73, the IRS mandates that you start withdrawing a certain amount from your traditional 401ks and IRAs each year. For those born in 1960 or later, the RMD age is 75. The penalty for not taking your RMD? A staggering 25% excise tax on the amount you failed to withdraw. For example, if your RMD was $10,000 and you missed it, you'd owe $2,500 in penalties. The calculation is based on your account balance at the end of the previous year and your life expectancy factor from IRS tables. This rule ensures the government eventually collects taxes on your pre-tax contributions and earnings. While RMDs are mandatory, there are ways to manage them, including qualified charitable distributions, which we'll touch on later. But first, let's talk about the biggest mistake people make with their tax brackets. Here's the mistake costing many people $50,000 or more in taxes: withdrawing too much at once, pushing yourself into a higher tax bracket. Many retirees simply take what they need, not realizing the cumulative effect. Imagine you need $50,000 for a home renovation. If you take it all from your 401k in 1 year, that $50,000 is added to your other income. If your other income is $40,000, that $50,000 pushes your total to $90,000. You might jump from the 12% bracket into the 22% or even 24% bracket for a significant portion of that withdrawal. A better strategy often involves spreading withdrawals over multiple years to stay within lower tax brackets. For example, taking $25,000 this year and $25,000 next year could keep you in the 12% bracket for both amounts, saving you thousands compared to a single, larger withdrawal. This single strategy alone could save you tens of thousands over your retirement, but it requires careful planning and understanding your marginal rates. Another costly error many make, especially in early retirement, involves Roth conversions. While Roth conversions can be brilliant for future tax-free withdrawals, doing them incorrectly during your withdrawal phase can backfire spectacularly. The mistake? Converting a large sum from your traditional 401k or IRA to a Roth IRA in a year, you also plan significant withdrawals. Both the conversion amount and your withdrawals are considered taxable income in the year they occur. This can instantly push you into a much higher tax bracket, negating any future Roth benefits with an immediate, massive tax bill. For instance, converting $100,000 to a Roth and taking a $30,000 withdrawal in the same year could put $130,000 into your taxable income, potentially moving you from a 12% bracket to a 24% or even 32% bracket. Always consider your current year's income and planned withdrawals before executing a Roth conversion, where you could face an unwelcome surprise come tax season. But what about the specific order of withdrawals? The order in which you tap your retirement accounts can significantly impact your overall tax burden. A common strategy is to prioritize taxable accounts first, then tax-deferred accounts like 401ks and IRAs, and finally tax-free accounts like Roth IRAs. Why this order? By drawing from taxable accounts first, you give your tax-advantaged accounts more time to grow completely tax-deferred or tax-free. For example, if you have a brokerage account, a traditional 401k, and a Roth IRA, you might first use funds from your brokerage account, paying capital gains taxes at potentially lower rates. Then you draw from your traditional 401k, managing those withdrawals to stay in lower tax brackets. Finally, you'd use your Roth IRA, which offers completely tax-free withdrawals in retirement. This methodical approach can maximize the longevity of your savings and minimize your lifetime tax liability, but it also depends heavily on your specific financial situation and needs. A common question is whether to take a loan from your 401k or make a withdrawal. This is not a trivial decision. A 401k loan allows you to borrow up to $50,000 or 50% of your vested balance, whichever is less, and repay it with interest to your own account. The interest rate is typically prime plus 1 or 2%, and repayment terms are usually 5 years or longer for a home purchase. The upside is no taxes or penalties on the loan itself. The downside? If you leave your job, the outstanding loan balance often becomes due immediately, and if you can't repay it, it's treated as a taxable withdrawal subject to penalties. A direct withdrawal, on the other hand, is final and irreversible, incurring immediate taxes and potentially penalties. For example, borrowing $20,000 could be a smart move if you're confident in repayment. But if repayment is uncertain, a loan can quickly turn into a forced, costly withdrawal. This choice hinges on your job security and ability to repay. Sometimes, life throws unexpected curveballs, necessitating a hardship withdrawal from your 401k. These are generally allowed for immediate and heavy financial needs, like medical expenses, preventing eviction or foreclosure, burial expenses, or repairing damage to your primary residence. While a hardship withdrawal avoids the typical 401k loan repayment issues, it is subject to income taxes and the 10% early withdrawal penalty if you're under 59 and a half. For example, if you need $15,000 for an emergency medical bill, that $15,000 will be added to your taxable income for the year, and an additional $1,500 penalty will apply if you're young enough. Furthermore, you cannot contribute to your 401k for 6 months after a hardship withdrawal. This option should be a last resort, as it significantly depletes your retirement savings and comes with immediate tax consequences. Always exhaust other options before resorting to a hardship withdrawal, because the long-term cost is substantial. One of the most powerful and often overlooked strategies to manage your 401k funds is a direct rollover. This involves moving funds directly from your old employer's 401k plan into an IRA or your new employer's 401k without ever touching the money yourself. The key benefit? No taxes withheld and no potential for the 60-day rollover mistake. If you receive a check made out to you, you have 60 days to deposit it into another retirement account, or it's considered a taxable distribution. Miss that deadline, and you're hit with income taxes and the 10% penalty. With a direct rollover, the money goes straight from institution to institution. For example, if you leave a job with $150,000 in your 401k, instruct your old plan administrator to send the money directly to your IRA custodian. This simple step prevents a massive tax headache and ensures your money stays invested for your future. This is a critical distinction that saves countless people from costly errors. For those over 70 and a half, qualified charitable distributions, or QCDs, offer an intelligent way to manage RMDs and support causes you care about. A QCD allows you to directly transfer up to $105,000 from your IRA to an eligible charity each year. The beauty of this is that the transferred amount counts towards your RMD for the year, but is not included in your taxable income. For instance, if your RMD is $10,000 and you donate $10,000 via QCD, you've satisfied your RMD without increasing your adjusted gross income. This is especially valuable if you don't itemize deductions, as it provides a tax benefit you wouldn't otherwise get. This strategy not only helps you meet your RMD obligations, but also reduces your taxable income, potentially keeping you in a lower tax bracket. It's a win-win for both your finances and your philanthropic goals, but remember, it only applies to IRAs, not directly to 401ks. We briefly mentioned the 60-day rollover rule, but it's such a common and devastating mistake that it deserves its own warning. If you initiate a rollover from a 401k or IRA and the check is made payable to you, you have exactly 60 calendar days from the date you receive the check to deposit it into another qualified retirement account. Fail to do so, and the entire amount is treated as a taxable distribution. This means you'll owe income taxes on the full amount, plus the 10% early withdrawal penalty if you're under 59 and a half. Imagine receiving a $100,000 rollover check, getting busy, and missing the deadline. You're now on the hook for perhaps $25,000 in taxes and penalties. This single oversight can decimate a significant portion of your retirement savings. Always opt for a direct rollover to avoid this high-stakes deadline entirely. It's the safest way to move your money and protect your future. Understanding 401k withdrawals is complex, but with strategies like the Rule of 55, careful RMD management, and avoiding the tax bracket trap, you can save thousands. The biggest takeaway is that timing and method profoundly impact your tax bill and the longevity of your savings. If you're now wondering how to choose the right investments inside those retirement accounts to maximize growth before you even think about withdrawing, watch our video on the 3 best index funds for beginners. It's the perfect next step to solidify your financial foundation. And if you found this breakdown helpful, consider subscribing for more unbiased personal finance insights.